Hello everyone, and welcome. In this presentation, we're going to dive into a fundamental concept in managerial accounting, job order costing. We'll explore how businesses, especially those that create unique products or services, figure out exactly what their work costs. This is a journey from individual parts to overall profit. Here's a look at our agenda. We'll start with the why, understanding why job order costing is such a critical tool for making strategic business decisions. Then, we'll define what it is and see the wide range of industries where it's used. The bulk of our presentation will be the how, where we'll follow a step-by-step case study for a single job, looking at how to trace direct materials, track direct labor, and handle the complexities of manufacturing overhead. Finally, we'll see the result, calculating the total cost for the job and the cost per unit. So, let's begin with that crucial question. Why does this matter? The answer is strategy. Let's look at this scenario of a marketing agency. Their challenge is a common one. Their biggest client by revenue, paying $20,000 a month, was exhausting the team's resources. At the same time, a smaller client paying $8,000 a month was very low effort. The critical question for management is, which of these clients is actually more valuable to the business? To answer that question, the agency took action. They used job order costing to track all the labor hours and apply a share of their overhead costs to each client individually. The discovery was startling. The profit picture was the complete opposite of the revenue picture. The high-revenue client had a razor-thin 5% profit margin, while the low-revenue client was delivering a healthy 40% profit margin. The takeaway here is powerful. Job costing provides the hard data needed to stop chasing empty revenue and start focusing on activities that build real sustainable profit. Now, let's formally define our terms. Job order costing is a system used by companies that produce many different kinds of products or services. In this system, each unique product, customer order, or project is called a job. It's important to think beyond the factory floor. A job can be a specific style of jeans for a company like Diesel, a custom-built airplane for Boeing, a special print order from Vistaprint, or even a service, like a deluxe bicycling vacation in Italy. The core idea is that we need a way to trace costs to each of these specific, unique jobs. To see how this works in practice, we're going to follow a case study for Job 2B47. The company is Yost Precision Machining, and their client is Loops Unlimited. The job is to produce two highly specialized experimental couplings for a new roller coaster at Magic Mountain. The contract is set up so that Yost will be paid based on the determined cost of the job. So, our mission is to follow Job 2B47 from start to finish and see exactly how its costs are calculated. The central document in this entire process is the job cost sheet. You can think of it as the job's financial fingerprint. This single document is where all the costs for a specific job are accumulated. As you can see on the partial sheet here for Job 2B47, there are three main sections to track costs: direct materials, direct labor, and manufacturing overhead. Let's begin the process of filling it in. Our first cost component is direct materials. How do the costs of raw materials get assigned to a specific job? Well, after management issues a production order, the production team uses a document called a materials requisition form. This form is used to request specific parts from the storeroom for a particular job. If you look at the example here, materials requisition number 14,873 is for Job 2B47. It lists two M46 housings and four G7 connectors with a total cost of $660. This $660 is the very first cost that gets added to our job. Next up is direct labor. These are the wages for employees who physically work on the product. This time is tracked using an employee time ticket. Let's look at the time ticket for Mary Holden. It's important to see how costs are separated. First, you can see she spent 5.0 hours on job 2B47, which at her rate of $18 an hour comes to $90. This is direct labor and goes directly to the job. But notice, she also spent 1 hour on maintenance. This $18 cost is considered indirect labor because it supports the whole factory, and it will be handled differently in the overhead bucket. For now that $90 of direct labor is added to our job cost sheet, this brings us to the most complex part, the overhead challenge. What do we do with costs like the factory's electricity, the production manager's salary, or the grease used in the machines? These are all indirect costs, meaning it's impossible or impractical to trace them to a single job. They are also a mix of both variable and fixed costs. So, here's the question. If we need to determine the cost of job 2B47 today, how can we possibly include a fair share of the annual electricity bill? The answer is that we can't use actual real-time costs. We have to estimate. The way we solve this problem is by calculating a predetermined overhead rate. This rate is calculated before the period begins and is used to apply overhead costs to all jobs throughout the period. The formula, as you can see, is the estimated total manufacturing overhead cost divided by the estimated total amount of the allocation base. An allocation base is a measure, like direct labor hours or machine hours, that is believed to drive overhead costs. It acts as the link between a job and the factory's overhead. Let's see how Yost Machining calculates its rate. They've chosen to use direct labor hours as their allocation base. First, they estimate their total manufacturing overhead for the coming year. This includes $640,000 in fixed overhead and $160,000 in variable overhead, for a total estimate of $800,000. They also estimate they will run 40,000 total direct labor hours. To get the rate, they divide the $800,000 in estimated overhead by the 40,000 estimated direct labor hours. The result is a predetermined overhead rate of $20 per direct labor hour. This rate will be used for every single job they produce all year. Now, we can finally complete the job cost sheet for job 2B47. First, we need to know the actual amount of the allocation base used for this job. The completed sheet shows that a total of 27 direct labor hours were charged to job 2B47. Now we apply the overhead using our predetermined rate. We take the $20 per direct labor hour rate and multiply it by the 27 actual hours used on the job. This gives us an applied overhead of $540. As you can see on the completed job cost sheet, we now have all three cost components. We have arrived at the bottom line for job 2B47. Let's summarize the costs from the completed job cost sheet. Direct materials totaled $1,404. Direct labor was $446. And the manufacturing overhead we just applied is $540. Adding these together gives us a total product cost of $2,390. Since the job was to produce 2 couplings, we can now find our unit cost. We simply divide the total cost of $2,390 by the 2 units, which gives us a unit product cost of $1,195 per coupling. Let's wrap up by reviewing the key takeaways. First, job order costing is an essential tool for any business with unique products or services, as it informs critical strategic decisions. The job cost sheet is the central document where we track our 3 main types of cost: direct materials, which are traced via requisition forms, direct labor, traced via time tickets, and manufacturing overhead, which is applied using a predetermined overhead rate. This rate, which is based on estimates, is the key tool that allows for timely costing during a period. Ultimately, mastering this process allows managers to truly understand product profitability, set intelligent prices, and make better informed decisions.